Welcome, everybody. The market update desk with Scott Riley, NMLS 157524. Well, we're feeling a lot better after knee surgery, getting back on the horse, getting back to these updates. Apologize, we've missed a few days here. The market has definitely been not our friend when it comes to mortgage rates. We had significantly higher retail sales than expected last week, which definitely turned the bond market against itself. And there's more Fed speak with where the market's going. Let's kind of go into it. So stocks and bonds are unfortunately off today again to start the week. Pressuring bonds in particular is more stimulus announcement from China, as well as comments from Atlanta Fed President Raphael Bostic. So China cut its central bank rate by a quarter point, 25 basis points, in their latest effort to support their housing and stock market. Now, remember, in China, the majority of people invest in real estate versus the stock market for a multitude of different reasons. So the real estate industry and market is extremely important in China, and it's been off for years now. And they definitely, as you can see from the continued stimulus, still have very big concerns on it. So Raphael Bostic, who's been, I'd say, probably one of the more hawkish members on the Fed, earlier this month said that he'd be open to the idea of pausing rate cuts in the upcoming November 7th meeting if data supported it. In the most recent media appearance on Friday, Bostic made the case for patient reductions in the Fed funds rate, quote, eventually getting to somewhere between 3 and 3.5% by the end of next year. He said he's not in a rush to get to normal. So it's another voice out there that's talking about slowing down rate cuts, pausing rate cuts. This all started with, as we've talked about, some of the jobs data that was out there and consumer spending and retail sales. So, and the reason why we keep getting this challenge in the 10-year bond and mortgage rates is a lot of concern that we may not be getting the additional rate cuts that we're planning this year, and maybe not as many as last year. Now, one of the things Bostic seems concerned about is that inflation could stall out because the Fed hasn't been restrictive enough long enough, so he wants to be patient. His comments are a bit surprising, though, as the Fed has been and is still very restrictive on economic policy. It's hard to think we'd get any tighter than where we are on Fed policy, but again, he's definitely one of the more hawkish ones out there. The 10-year bond moved higher again today. It looks like we're up another 10 basis points today. So over the last 3 weeks of October. Now, it's not an unusual occurrence but there's still not a lot of clarity as to why it's moved up as much as it has. Let's go into a couple other things here. So I'm going over my notes here. So there's still a lot of things that are going to come out yet this month. We're going to get ADP on November 30th. We're going to get PCE October 31st. Then we're going to get the new BLS jobs report November 1st. Fed meeting on 7th, and then the election. So we got a lot happening out there, which is creating this volatility. So this week in particular, we've got mortgage applications on Wednesday, existing home sales Wednesday, then another very important 20-year bond auction. Will the market eat up these higher returns that came on the 10-year and give us more activity on the 10-year? In this 20-year auction. So we'll have to wait and see on that. Thursday, initial jobless claims, new home sales, and then durable goods orders on Friday. So we have a little bit of data, not monster data that we've, for jobs data and inflation data, but still very important. On the technical side, mortgage-backed securities broke beneath an important level of resistance at 100-day moving average, and we're now kind of dropping down with the 200-day moving average in sight, which is not good. We've lost a lot of ground on mortgage-backed securities, which is where mortgage rates come from. And the 10-year bond, it's testing overhead resistance at 4.13, which is an important Fibonacci level that is very important. And if it doesn't hold, the next 200-day moving average resistance level is at 4.175. Huge difference from where we were 5-6 weeks ago when we hit I think it was 3.63 on the 10-year. So let's pay very close attention to this. In fact, today, the 10-year bond, mortgage-backed securities are down 47 basis points. 10-year bond is up 10 to 4.17. In fact, we're at if it closes above this 200-day resistance level, I'm a little concerned about it. So we've been on this upward path on rates. Doesn't look like we're going to come down anytime soon. Now, what we are seeing in the real estate market is a little bit more inventory. We're having some buyers have a little bit more luck negotiating with sellers. If you look at the arc of an entire calendar year, mid-October, November, December, January, these are the times you need to be extremely active with looking for homes, because inventory might tick up a little bit, which we've seen, and sellers might be open to negotiating, where earlier in the year, spring, summer, early fall, they're not as open to negotiation because there's plenty of buyers. Do yourself a favor, give us a call. We'll help you get pre-approved, put you in the best position possible to get your next house. Give us a call, 616-293-2189. We hope you have a great afternoon.